are in listen-only mode.
Good evening to everybody. This is Mike Murphy with CattleFax, and I just want to welcome you to the CattleFax Trends plus Cow-Calf webinar here for our January edition. We appreciate all of you being a part of today's discussion, and we hope that there's some great information that you're going to be able to receive from everything. As we get started, hopefully you can show me your little hand. There's a little spot there that says that you can actually raise your hand to be able to hear us speaking at this point in time. And if you can show that to us, that would be great. And that would also be a sign for us to be able to see that you are seeing the actual PDF document with all of the information that we have as well. So I see a few of the hands going up. I know maybe not all of you know exactly where it is, but I think that we're in pretty good shape as I see some of the hands being raised. So with that, we're going to go ahead and get started with today's discussion. First of all, I want to thank Elanco. They're the sponsor of the CattleFax Trends Plus webinar. We really appreciate their opportunity to be with us today, and we're going to have some good discussion, not only with our information, but there'll be some things that Casey McMurphy will be covering with Elanco here a little bit later on in the discussion as well. So as we start today's discussion, just to give you a little bit of a perspective of what we're going to be talking about, and obviously we're in a very chaotic period relative to the markets in here in the course of the last several weeks. So we want to really give a good in-depth review and preview, if you will, of what the market's going to look like as we go forward from all sectors: fed cattle, feeder cattle, and calves. We'll talk a little bit about what's going on with the feed and forage situation, and then we'll also talk about some of the expectations for calves and bred females as we look to something the industry hasn't really experienced in for quite some time, and that's an expansionary mode to the marketplace. So we'll be looking at that here in some of the information as well. So as we go ahead and we start to move forward with the information, again, I'm Mike Murphy with CattleFax. You'll hear Lance Zimmerman a little bit later on relative to the CattleFax team, and we've got Casey Murphy from Elanco that will be on here a little bit later as well. So as we think about the market situation and just looking at the objectives here, we want to talk things from a short-term perspective, really looking at the market over the course of the next kind of 6 to 9 months, again, on all three sectors: fed, feeders, and calves, also looking at the cull-cow situation. But we also want to just start to define things in here from a bigger picture perspective as well. Looking at things over the course of the next few years, looking at where we are relative to the market from that standpoint as you start to kind of make business decisions from a bigger picture perspective. So as we evaluate things from a short-term perspective, and those that are CattleFax members following the update week to week, you certainly have seen us discuss over the course of the last several weeks a lot of the basics of some of the things that have suggested to this market that maybe we've gotten a little bit too rich in terms of the fed cattle market. And what we're illustrating with this graph is just looking at the fed cattle market, and we use a market year beginning July 1. And what that does is it really allows us to have a better understanding of what the market looks like as we go through that time frame around the new year, if you will. So you look at this market year, and again, it's July 1 to June 30th, and that lighter blue line is what the seasonal would look like to a cash-fed cattle market. And really what it illustrates is a market that pushes higher right through the holidays into the new year and going into the early spring time frame. The darker blue line is an illustration of a contra-seasonal year. And you can see what that illustration looks like. It's a market that's got more of a downward trend going into the spring time frame. Now, it's important to note that these indexes are off of this left axis, and then the black line, which is the current year we're in, is off the right axis. And all we really want to do with the message in terms of this chart here is to give you a visual. This is not to imply that the market's got a specific price level in mind. So when you look at that dark blue line, don't imply that, well, the market's going back to the low 150s. That's not what the data would suggest. It's just saying that if we're following more of a contra-seasonal year, that the trend will be more of an underperforming market going into the spring time frame relative to fed cattle. And then as you find that low out there in the spring, you would start to turn back higher going into the summer. Some might be asking, why with such a tight supply of cattle that we have, why would we be in more of a contra-seasonal market environment? And I think there's some factors that we all have to kind of understand as we start to evaluate the market. Number one, we have to recognize that we're dealing with a situation relative to competing needs. That when you look at it on a retail, wholesale, or live basis, beef is record high to both pork and poultry. So we've lost a little bit of our advantage compared to like the total year of 2014 relative to our competitors on the protein sector. The second thing is we've seen a pretty significant shift relative to our ability to export both beef and pork. And that's because of what's gone on with the shift in currencies as we look at our key trading partners. It's costing with our key trading partners about 10% more than it did a year ago when you make a January year-to-year comparison for the product, whether that's beef or pork. And those are the types of things that kind of slow the demand down. And then the final thing, as you start to think about it in terms of the market, is leverage. And leverage and margin for all the participants within the beef industry. And that actually includes consumer, retailer, food service, packer, and so forth down to the production segment. We've had the leverage in our favor from the cattle sector, the production side, for most of 2014. And it appears that we're now in a process of shifting some of that leverage back into the favor of somebody above us within the chain. And again, that goes all the way to the consumer as you look at that. So those would be the three reasons that I think we have to earmark to say why this potentially could be a contra-seasonal type of a market. Now, as we look at this from a fed cattle perspective and we start to kind of evaluate where we are relative to the feeder cattle side, you start to have some of the same sort of ideas of the direction of the market. And again, you look at this chart as we measure it, that dark red line is that contra-seasonal pattern. The green is more of the seasonal. And those indexes, are off the left axis. This year's off the right axis. You can see the direction of what we'd find overall going into the spring. It's a cash feeder market that would be moving lower. Now, this is where I would step back and caution ourselves relative to the market on a couple of fronts. When we think about the feeder cattle market, we've had the spring feeder cattle in the course of the last 5 to 7 days trading between $2 and $2.05 a hundredweight. And yet, as you look at our 750-pound steer price, it's trading somewhere right around 222, 223 is likely where we're going to finish the week, this particular week. So the point being is that there's more risk relative to the cash than there might be relative to the futures as we look at things. So those that are sitting in an environment from a stalker perspective that have not been able to take advantage of what the market was providing from a risk management perspective this fourth quarter, we need to caution ourselves of getting too bearish the futures from current levels. Now, if we had some sort of a real strong rally to futures, then we might utilize that as an opportunity to protect ourselves. But we got to have a little bit of caution when you got such a strong basis built into the market. Now, those looking further out into the third quarter in terms of marketing cattle off of some sort of a summer grass program, as you look at this chart, obviously you can see as we find those lows, then the market starts to rally back into that third quarter period. Most times you're not going to go back to in a contra-seasonal environment where you establish these highs, but certainly again from where we've seen these fall feeder cattle trading, we would certainly expect that the market to be better than that level of say 202 to 208 where the fall feeders have been trading in here in the course of the last week. We should see a better market going into that third quarter time frame than what was priced into the future. So the same sort of component as you start to think about your position, don't panic if you're one of those summer stocker operators. So to summarize what we've got here with the feeder cattle market, those on the winter grazing operations should expect more pressure to the cash feeder market going into the spring. The futures have priced a lot of that correction already in. Those dealing with summer grass operations should expect that the cash feeder market will be pressured in the spring, but then recover back into the fall, and certainly should have a spot where we could recover back into, say, a 215 to 230 area as you go in towards those fall highs. No doubt when we think about that, specifically that third quarter time frame, we've got to keep in mind that corn could certainly play a role here relative to the market for that period. As we look at things from a lighter animal, so those that might still be needing to buy a few cattle for your summer grass period, or those that still have some of these lighter weight cattle that they're trying to market, this is a market that really stays very well supported all the way into that early March time frame. And then you start to see it taper off a little ahead of what the long-term seasonal would suggest, about a month, if you will, for the most part. It'll start to soften in this contra-seasonal environment. But really, as we look at it in here, between really in the next 45 days, this lightweight market is very well supported and could get a little bit stronger. Part of that just goes back to that demand concept of those still trying to fill their needs from a summer stocker perspective. Now you see the weakness in the spot cash market on these calves, or on a 550-pound steer, going into the spring. What should happen is as we go through the late spring into the summer, we should find where that the market will stabilize, but in the spot cash market going in towards the fall, likely to have a little bit more pressure. Now, we will review this discussion as we go to our June webinar, and obviously a lot of things can change as we know how quickly these markets move. So we'll give you an update at that point in time, but this just gives you a perspective for those that are looking way out there towards the fall time frame. If you're looking to market cull cows, those who have carried their cows from weaning into this winter time frame, we've always referred to this program as being a very successful program overall. And obviously, as you look at this correction that we've had in the market in here in the course of the last couple of months, where we started here during weaning in that November-December time frame on these cull cows, we're probably going to come back towards that price level, but at this juncture, we may not exceed that. So a little bit of a disappointment on the cull cow sector. It's not to say that you're going to lose money if you retain these cows into this winter time frame, but it may not be as much of a windfall as we would have had, say, a year ago as we look at this market. And then as we look in there towards the late spring and going into the summer, the cull cow market will go ahead and tail off going all the way into the fall. And that's why we always encourage producers, if you happen to lose a calf out there this winter, spring, it's a kind of a cow that you feel like that you're going to get rid of, we certainly would encourage that to do it sooner than later, just based on what this market looks like from a very big picture perspective, if you will. So that's where we sit from a short-term perspective. What I want to do is just take a few minutes and transition as we think about things from a long-term perspective and what we're in the midst of today, and that is expansion. And the first slide that we're evaluating here is the heifer slaughter as a percent of fed slaughter. And as you see there on that left axis, when you get down into this, say, 35% level, that's a sign of an expansionary period. We haven't had this since that early to mid-1990s window. But we're in the midst of having some expansionary environment going on, and that's a reflection of Mother Nature being more forgiving in many parts of the country, and with the record large profitability that we've seen in here at the cow-calf sector, especially in 2014. With expansion, what should we expect as we look a little bit longer term? And that is, we should start to expect where our supplies of beef are going to grow over the course of the next few years. This is a measurement of per capita net beef supply, which is taking our domestic slaughter, multiply that by weight to get to production. You add in imports and take away those exports, and you get a net beef supply. And as you can see in here, we still expect a tighter supply in 2015 compared to 14. But then that supply on the beef sector starts to grow back into 2016 and 17. That growth is important because what that's really suggesting to us is that we're likely have seen the high end of the range relative to the market as we evaluate things. The other component that we have to watch is our competitors, and this is a measurement of the net meat and poultry consumption or supply, however you want to define that. So that's pork, beef, and poultry. And this year in particular, we're going to see an actual increase in our supply in 2015 relative to 14. That's clearly a reflection of an increase in both the pork and the poultry sector. But looking forward, you can start to see as you look in there towards 2017 the type of increases that we're expecting to find in total meat supplies of about 10 pounds during this next few year period. And this is the type of information that we step back and we evaluate and we say, as we think about the fed cattle market and as it applies back to feeder cattle and calves, are we sitting in here where essentially we've seen the high end of the range for the market? And that's somewhere in this low to mid 170s basis the fed. You look at it basis the feeders, it's somewhere in this kind of 240 to 250 mark. And if we look at a calf, if we're looking at kind of a Central Plains or a Northern Plains calf at a 5 to 5 1/4 weight calf, we're really probably talking about $3 a hundredweight. That's what the supply information really implies to us, is that we are at the high end of the range. So with that in mind, we all need to step back, and as we start to evaluate our businesses, we got to understand that now there's probably more of that downside risk relative to the market than upside. That doesn't imply that we won't be profitable, especially at the cow-calf sector as we go forward the next few years. We're just trying to give you a perspective that as supplies grow, the only way that price can really advance is with a lot of growth in demand. And that's going to be a challenge, especially as we start to think about some of the things going on from a global perspective in terms of our market. So as we transition and Lance Zimmerman comes in and starts to talk, we just want to leave you this chart here as we look at the fed steer price. We had a significant breakout. We're now attempting to define the range of the market. We feel like that we've already tested at the high end of the range as we look at the course of the next few years. And I think that this will be a good perspective and a good launching point for Lance to come in and start to kind of talk through relative to the bred female side as we look at things. So with that, I appreciate your time, and I'll turn it over to Lance Zimmerman. Oh, excuse me. We have two more slides in here relative to the feed grain and forage sector, and that's my fault. I forgot about those slides. This is really a factor as we look at things that's supportive to the values of calves as we look at the next couple of years. And that's because we've been able to establish a situation in here through the course of the last couple of years of a bigger supply environment than we've had from a historical perspective if you looked at this in that 2010, 11, and 12 time frame. So our corn situation, as we looked at stocks-to-use ratio, we're better supplied, if you will. And the net result of that is that that's going to help keep prices capped. That doesn't mean that we won't have some significant volatility within a price range. We could certainly be trading somewhere maybe at 5, 5.25 on the high end of the range, and say down to say 3, 3.25 at the low end of the range. But I think as long as we can continue to have supplies that are somewhere in this 12 to 16% level as we look forward, and we do believe that will be the case as we look in here towards this next crop year, that we're going to be able to have less of that real extreme values to corn like we did at a couple of different time frames here in the last few years. And what that will do is also keep a little bit more pressure on hay values as well. And you can really see that when you start to look at alfalfa hay in here, which is a really good reflection of what's going on with the corn market. It's a little bit of a laggard, but you've really started to see more of that price declining in here. On a U.S. average, we're talking about a little over $40 a ton. And likely we're going to see more pressure going into the second half of this year when we start to look at hay values as well. So this is one component, if you will, as you think about it from a cow-calf standpoint, that certainly is going to work to our favor from an overall margin and return perspective as we look at both corn and hay values in terms of the marketplace. So with that, I will now turn it over to Lance Zimmerman, and we will be back in touch with you at the end to take any questions. Thank you very much.
All right, well, as we get started on taking some of this information Mike shared and really relating it back to the cow-calf level in terms of what does this mean for us going forward if we truly are in this expansionary phase as an industry. And I think this is a great place for us to start this discussion. As we look at 2014 and the profitability that we had as an industry, pretty easy to see that carving out almost $1,100 of combined per head profits among all four of the major supply sectors is pretty clearly and very easily record high profits as an industry. When you look at the packing segment all the way down to the cow-calf segment, what this should tell us is we were in an environment where we were able to capture a higher percentage of the retail dollar, of the consumer spending dollar on beef than we ever had before. And when you carve out these individual segments and you see the cow-calf segment capturing $550 a head, the stocker operator being able to capture on a U.S. average basis $300 a head, and even the feed yard capturing $200 a head, these are all levels that whether you look at the entire industry or one individual segment were easily all-time highs. And I think what we got to keep in mind as we go forward is as we go into this expansionary environment, we're in a situation where we're going to continue to capture a very high percentage of that retail dollar. But to expect a situation that we went through in 2014 to repeat itself in 15, just simply from a historical standpoint, isn't going to be realistic. The good times are still here for a while longer. We're still going to see very exceptional prices, whether you're talking about the calf market, feeder cattle market, or fed cattle markets. But to expect the situation we went through this last year with both tight beef supplies, tight pork supplies, and poultry supplies, and seeing that situation repeat itself in 15 simply isn't realistic. And so as we think about expansion, how do we make sure as cow-calf producers that we go through this expansion in a way that maybe we don't see $550 per head profits in 2015, but how can we go through an environment where we can still preserve very profitable levels at $300 a head, $400 a head, or whatever that might play out to look like as we go into the next few years? Basically, in short, how can we ensure that we maintain strong profitability as we try to pursue some herd expansion in each of our operations? And so as we look at this, what is the expansion going to look like? And I think over the last two webinars, we've given you that that description and painted that picture for the industry going forward here over the next 5 years. And as we look at 2015, we'll get the official data from the USDA next week. We feel fairly confident that we're going to be looking at about a 400 to 500,000 head expansion that occurred over the course of 2014 when we get those January 1 inventory numbers. We'll add in roughly just shy of 1 million head by our estimations over the course of 2015, and then pretty similar increase year over year as we work into January 1st, 2017. Now, whether we sit back and we add in 2.5 million head over the next 3 to 4 years, or it's somewhat less than that or more than that, really isn't something that we need to get hung up on. Maybe in 3 years we take this level up to 33 million head. Maybe it takes 8 years to get to that level. But I think the important thing we need to keep in mind, rather than getting hung up on a total supply number, is how can we go about this profitably? We obviously know through past efforts in expansion in the early parts of the 2000s that drought cut us short. But how can we make sure that regardless of those factors that are out of our control, that we can do so at a level that we can make sure that we're not sacrificing the future viability of our family operations? And I think the part where we need to start this discussion is where are our bred cow prices right now. And you can see here this is a seasonal index over the 12 months starting on a July 1 basis and ending at the end of June. And what you can see is we came out of a period here at the end of 2014 with these bred cow prices right here around $2,500 for a typical bred cow, 2 to 3 year old type bred cow. And seasonally you can see we still have the most aggressive increases still in front of us here over these next 3 months. And it's not going to be out of the realm of possibility to expect female prices in this $2,600 to even $2,900 area as we go through the end of the winter period and into this spring time frame. We still have some very reasonable increases in front of us on this bred cow price. The logical question needs to become, is that too much to be spending on a bred female, knowing that there's going to be a huge range in price around those averages just based on quality and regional factors? Easily can sit back and say that the practical range around that number is probably anywhere from the low 2,000s to the low 3,000s very easily based on quality and type. And so as we pursue this idea of expansion, I think we go back to some stuff that we shared with you early on. That very clearly the price that we're paying for bred females by and large tends to be dictated based off of what we paid or got paid for those calves the preceding fall. And you can see here on an annual basis, year in, year out, you can expect it to take 1.5 calves to pay for a bred cow. During expansion type years, you can see those numbers can increase up into that 1.6 area and even exceeding that in a few cases back in the early 2000s. Now, as we talk about that for this year, calf prices this fall, upper twos, almost $300 a hundredweight in some instances for those lightweight calves, using a metric where we're going to be in 15, somewhere in our estimation around this 1.6, that would actually put you on an annual average basis, as we look at that seasonal that Mike carved out for us, a calf price somewhere in that $260 a hundredweight for the year. That translate back to an annual average on the bred female price around $2,400. Now, if you think back to the graph I just shared with you right before this one, that honestly very easily could be too low as we think about what's going on in this bred female market coming into this year, knowing that we'll likely break down these values as we get into summer, obviously, and then rebuild that market again next fall. And so as we think about that, we know here what the market's got played out for us here the next 3 or 4 months, likely the upper $2,000 for averages. We know what the annual price expectations say it should be based on maybe a 1.6 ratio to this year's estimated calf prices at about $260 a hundredweight. But then let's combine into it the factors of, what would we typically see these calves bringing back to our operations. And this is some work that some of our team has done here in the office, just looking at what happens during an expansion environment. We know that as you increase supply, all other variables equal, prices are going to go down. We're very familiar with that price trend due to past expansions. And so as we look at an expansion that was actually a fairly robust expansion in the not too recent past, we look back to that 1990 to 1996 era. And what we've done is we've basically taken those prices and we've indexed those prices to start out at today's levels. And what I don't want you to get too hung up on is necessarily, this starting price at $250 or the ending price clear down here with a bottom, kind of in those 160s. But I want us to keep in mind the general trend. And what you can see is as we went through this period, obviously we're going to give up some price. And yeah, there was a moment in here where in 2016 we saw it break down based on this past expansion year, an expectation that we should break it down in 2016, basically another year from now, and then a bump up in 2017. Again, I don't want us to get hung up on the exact shape of this particular market. There are a variety of nuances from a supply and demand standpoint, even a leverage component in the market that could cause this to look much different. But I think what we need to keep in mind is as we go through an expansion phase, we're going to see prices break down. The degree to which they break down is really unknown at this particular point in time. We need to see a lot of different things play out. What's the health of the economy? What's the health of retail beef demand? What do our export markets look like? There's a lot of things that even in our own estimations, we just can't forecast with any certainty 5 years down the road. But I think what we can take for certain is that through this period, even if we just handle this very conservative orange trending line, an average price expectation somewhere around $210 a hundredweight. Again, this year's annual average price was in the 240s. We anticipate this year's annual average price to be in the 260s. And so thinking that you're going to break down prices to average over a 5-year period around $210 is probably a fairly conservative estimate. If you think that break is too aggressive, obviously you can go with that gray line in that mid-240s range. If you think that we're too conservative overall to the low end, then you could go with a more aggressive price decline averaging about 180 over that price period. But again, just shaping out some expectations of what those calves might be bringing out of those females that you'd be looking to purchase during this expansion environment. As we think about it a little bit more directly relative to what your cash costs are per cow, I want to focus on this level here right down the middle, this $220 calf price. That's a little bit higher than the example shown in the earlier slide, but I think it's nice from the perspective that it's a 2.5% decline per year from the levels that we're forecasting for 2015. And as you look at that, and you look at the assumptions built below that, we're assuming that the average cow is going to be able to have 7 calves. We're going to assume that those cow costs are going to increase on average about 3% a year. Interest rates will be around 6%, and that cull cow value is estimated at about $104 a hundredweight with an average decline of 1% per year. Again, factoring in a market that's under a conservative supply increase through this expansion period. If your cash costs are anywhere from $600 to an extreme of $800 per cow per year, you can see what that dictates for what your market should be able to withstand for purchasing price on terms of a bred cow. Carving out an area where basically every $100 you increase on cash cow costs, you decrease your cow purchasing power by about $600 a head. And so again, kind of just layering in that general price trend information from the previous slide with some general, very basic information on cow costs. Now again, $600 for cash cow cost might be extreme to your area of the country. For others of you, that might be right on key. For others of you, we might not be building in nearly enough cash costs. But again, this gives you a benchmark to think about and again, work from as you think about your own cash costs and the purchasing power that you might have based on some of these assumptions. And so another layer to factor in there is that during an expansion, we also see the most aggressive prices being paid for bred females at the start of the expansion. as those appetite that cow-calf producers have to build their herds is at its peak. Now, we don't know, is 2014 the highs that we had in our expansion for our bred female prices? Are they coming in 2015, or are they in 2016? We don't know exactly where this peak is because we're fresh into this expansion. We'll know a lot more after we get through 15 and start our ledger sheets for 2016. But right now, let's just, again, pay attention to this trend. And I think what's important for us to realize is a lot of us talking across the countryside are realizing very quickly that cow-calf producers recognize how expensive these females have gotten and how quickly they've reached these levels. Maybe these prices have exceeded your risk appetite for purchasing females today. And if that's the case, I think the great thing that this graph points out to us is that maybe it's not best for you to jump all in right now in building your herd out to its maximum herd size and capabilities today. For some of you, financially, that might be a limitation from a cash flow perspective. Others, it might be a credit availability issue. For some of you just simply might not have the risk appetite, or for others of you, especially as we look at the southern plains, you might not have enough confidence in Mother Nature yet. And I think for all of those reasons, it would justify delaying or ramping up this expansion efforts on individual operations in a very strategic level. Maybe you only look back at your operation and you say you have the capability to adding on another 40% to your herd, but you take a strategic approach that in the first year you're only going to chew off 10 percentage points of that 40% increase. Then the next year you scale it up to 15%, and then your last year you have that remaining 15% that you can chew off the rest of the way. And by doing so, you're going to take advantage of this seasonal trend or this long-term trend that we see in expansion years, that as we get deeper and deeper into the expansion, the females become cheaper and cheaper. Might be a tool for you to keep in your toolbox, and certainly keep in mind as we get more and more length and more age to this expansion cycle. The other part that we haven't discussed much ad nauseum during today's discussion is really the idea of what are the supply and demand dynamics in this particular expansion. One of the things we need to keep in mind is that we have not seen an expansion cycle in the cow-calf industry since the early 1970s where we actually increased the cow herd size and in terms increased supply and beef production in an increasing demand environment. You look at the expansion we went through in the early 80s, the expansion we went through in the 90s, and the very limited expansion we went through in the early 2000s before drought cut it short. And in each and every one of those examples, we were trying to expand the cow herd into a decreasing retail beef demand environment. There's the potential, and it's not a given, but there's the potential today, based on what we've seen out of demand the last 5 years since the recession, that we could actually expand into an increasing demand environment. And I want to just give you a perspective of what that looks like. And so here, if we focus on 5 years from today, that 2020 time frame, today we're basically at that 28, 29 million cow level. What happens if we take this cow herd out to 33 million? And we'll just bypass the 31, 32 million assumption, but let's just focus on this 33 million, the most extreme situation plausible. We could still maintain profits of $240 per head at a cow-calf level based on the assumptions of steady demand, exports and imports completely offsetting each other each and every year over that 5-year period, and a cow cost that starts out at $570 per head and increases 3 to 4% a year through 2020. Now again, we're focusing on the most extreme situation here possible. Let's say we do very aggressively ramp up this expansion. What happens if we actually have increasing demand instead of steady demand to the tune of just 1% a year? If that occurs, we can basically add another $100 per head over that 5-year period to the cow-calf per head P&Ls. Increase that one more percentage point to 2% a year, and we can tack on again another $100 a head. And so very often we travel out in the countryside, folks will ask, why do we focus so much on demand? And this very clearly shows us how important demand can be, especially increasing demand as we're trying to increase our beef production capabilities. And so in summary, based on some of the stuff Mike shared with you as well as some of this, I think that we can expect that we're going to go through some price correction over the next 5 years within that upper end of the range, of price range that Mike kind of carved out for you all in his portion of the discussion. You know, leverage and supply tend to be the components that lean on price the hardest, and those would be the components that we would expect to escape from the pricing scenarios first. But I think we need to also recognize that we're in a long-term price range that's going to make it very profitable to be in the cow-calf segment, the stocker segment, and even the feed yard segment as we continue to build up these supplies. The expansion, you know, the herd can easily be rebuilt back up to that 32 million head level, probably in the next 3 years. But there's still some unknowns as to will it hit those levels. Obviously, talking about the cow-calf commitment that it would take to buy some of these females, it isn't cheap, and it isn't without risk. Whether you're talking about Mother Nature or you're talking about the cost of inputs, land, those type of commitments, it's very likely that this could be a slower expansion. But we think that through this period, it can still be a very profitable expansion for the cow-calf segment. When we think about this expansion, though, whether you're at the cow-calf level, the stocker operator level, or feed yard level, one thing's reigned true in all of the economic and production data that's existed out there today, and that's that the low-cost operator that always keeps his production targets and goals in mind always seems to find more success in the long run, being more profitable by focusing on his costs. And so I think as we look at this expansion environment, we need to recognize very clearly that there's not going to be a one-size-fits-all for the cow-calf segment in rebuilding the herd. For some of you, that's going to be buying bred females. For some of you, that's going to be developing females within your own operations. For others, it might be going out there and buying some young, high-quality heifers, developing on your own, but still focusing on selling more terminal-based breeding stock or terminal-based calves. Than it would be trying to segment a part of your own herd away just to develop females out of your own operation. Whatever it might be, I think we need to just focus on the cost side of the ledger sheet. Knowing what these markets do and how they perform in typical expansion environments, both from a cow cost standpoint as well as from a calf standpoint, will really help us carve out a practical range to build some opportunity in our operations going forward. And so with that, I'm going to turn it over to Casey McMurphy. He's one of the technical consultants for Elanco Animal Health, and he's going to share a quick message with you all. We're going to gather questions in the meantime, and Mike and I will come back at the end of Casey's presentation and talk with you. But Casey has a background in the cow-calf segment, grew up out in Oklahoma and works with his family operation out there, and also spent a brief amount of time in Arizona as well. And so glad to have Casey involved with this and Elanco involved with the sponsorship of this. And Casey, I'll turn it over to you.
Thank you. Appreciate the opportunity, guys, to get to talk tonight, and I'll keep it pretty brief. And fortunately, I have the opportunity to talk about one of the oldest technologies in the business, and yet still one of the most profitable things that we can do in the cattle industry, and as far as looking at return on investment. And as we ended there with keeping costs low in the herd, I think even though things like implants are an additional cost, we still see a huge return on that investment. And if we look at this slide right here, this demonstrates the impact of an implant over the life cycle of a calf. And I guess the point here, the big point here, is that implants are additive over the life cycle. And as we're out in the industry, we hear about premiums for non-implanted calves, or feedlots not wanting the cow-calf guy or the stocker guy to implant their cattle. And I think there's plenty of research out there to suggest otherwise, but one of the things I guess I want to get across here is even if you find yourself in that situation, make sure that you're getting paid for those instances where asked not to implant if you are, or at least in this case know the benefit of implanting. If you look at just a suckling steer calf, you're looking at about 18 pounds of gain depending on your weaning age of those calves. But if we just take a $2 average, as we kind of talked about here, that's $36 premium just for those calves to give an implant. And a dollar investment, you end up with $36 back. And it is very difficult to see those performance differences year over year. We can blame it on the weather. 18 pounds can be blamed on the weather, the grass, or anything like that. But again, these are over 40-year-old technologies that have been researched probably more than anything else out there. And if I'm confident in any technology, it would be an implant. And you can see those other numbers on the feedlot sector. We're looking at, over $100 in value out of these implants for just implanting cattle. So we can move on to the next slide with that in mind. So some of the, I guess, a little pitch from our end, but just so you guys know what the opportunities are out there. There's a few calf implants, suckling calf implants. We do have one implant called Component EC with Tylan. The E stands for estrogen, which is the compound in the implant, C for calf. That is approved for both heifers and steers at 45 days of age and less than 400 pounds of body weight. And all those several studies summarized show about a tenth of a pound in average daily gain is what I tell people for what you can assume on average. You can get more than that or less than that, but over the years you can expect about a tenth of a pound improvement in those suckling calves. And again, it is for both steers and heifers. Compudose, kind of a unique implant that lasts approximately 200 days. Also approved, but it is only approved for suckling steer calves, and those studies summarizes only as about 0.07 of a pound in average daily gain over that suckling period of the calf. Could move on to the next slide. If you're in the stocker segment, again, you saw that there's an additional about 33 pounds available to you by using grazing implants during that period, or if you're a cow-calf guy and you're going to background for 45 to 60 days, another opportunity to get some gain out of those cattle. Again, you're looking at $1 to $1.50 investment for these. You're going to step up in potency for those implants in these grazing periods, so it's going to cost you just a touch more, but again, you're looking at a tremendous amount improvement in average daily gain. This slide shows on the left side would be the Z would be a row grow implant. Again, all implants will work and improve performance. It's a matter of strategizing these implants with your system. The second one is the Compudose or Encore implants, the longer duration, slower release implants that we have. The G implant is a grass implant. It's a combination of trenbolone acetate with estradiol, which seems to be the most potent in a grazing situation. It should be our recommendation. And then there's also an S implant, a Component ES implant that is there on the end. But again, all implants, I'm a firm believer or promoter of implants, depending, but then strategizing which one works best in your situation. So, next slide, please. One of the unique things that Elanco has to offer with our implant line that no other implant has is the fact that we have a local antibacterial with our implants. Some of you guys, if you fed cattle, know or used our injectable. We have antibiotic Tylan. We actually have a pellet that goes alongside with our implants to help promote implant health. We actually have done studies to show that on the feedlot side, an abscess will cost you about 7% reduction in average daily gain compared to a healthy implant site. If that's just an abscess, and if it actually abscesses and ruptures, that's going to cost you more like 15.5% a reduction in average daily gain compared to a healthy implant site. So it is a huge factor. I know that the implants only are going to cost you $1 or $2, but the benefit you get is greatly improved when you actually have a local antibiotic with that. So all our antibiotics or implants have that. Compudose and Encore actually have an oxytetracycline as the antibiotic, local antibiotic. So next slide, please. And this is my last slide. Just a little push for what we have to offer. We do have the broadest implant line out there for suckling calves, grazing cattle, and these are those implants here. We also have implants that fit into the feedlot sector as well, but again, the unique thing about it is that we do have that local antibiotic to help promote a healthy implant site, to get all the benefit and protect your investment with that implant, and got lots of information as to how to work with your if you got an Elanco rep, work with them as to how you would strategize an implant program for your particular situation. But there's a lot of different ways, and there's no perfect science to how you manage that. But with that, thank you guys, and if you have any questions, I'll be here to answer those.
Thank you, Casey. Appreciate you guys. With Elanco, always been a great sponsor of the industry and things that benefit the production sector. Obviously appreciate your involvement as a partner with us on this, and we'll be sure to, if any folks have any questions regarding your products or your presentation, point those folks your way. So thank you, Casey. As I mentioned, we take this time at the end here to follow up with some questions at the end of the presentation, and so feel free to type those into the questions toolbar portion of your control panel. I know a few of the questions that came up early were relative to copies of the slides as well as recorded presentations, and we have been making a recording of this presentation, and we will be sending that out as a follow-up to all folks that registered for the event, as well as posting a PDF copy of the slide deck on our website. If you don't see the email, just know that you can follow up on CattleFax.com, go to the meeting section, and that information will be there probably as soon as tomorrow by noon, and have that available for your access. One of the other questions that came through was regarding the concept of a $240 per head profit per cow. For this particular producer, they mentioned, that's $60 per acre return based on their stocking rates, and that won't compete with crops. And the question would be, based on that, why would anyone expand? And I think for a lot of producers, this particular attendee in particular, obviously, crop production at current levels in some areas of the country, the incentive to expand won't offset those returns. But we got to recognize that this cow-calf business happens all across the countries in areas that crop production simply isn't a viable production tool. The only thing that land can be utilized for is grassland. And so as we look at expansion, we got to identify what are those areas where expansion is the most robust. And to be quite honest, there's probably not going to be a lot of expansion to be had in that Midwest production region where the pull into crop production is going to be so strong. When we look at the 2 to 3 million head of cattle we've lost over the last 5 years, the easiest place that we're going to expand is going to be in the southern plains and in the southeast. Pretty much due to crop production economics, we're going to rule out the Midwest. And quite frankly, we haven't seen a lot of culling activity in the northern plains, and so the ability to expand there will likely be more limited just because we haven't lost too many cattle up in that area of the country. So as we think about expansion, think about those true range grass areas, a lot of them that have been hit hardest by drought over the last few years. Looking through some of the other discussion questions here, is the value for bred cows a break-even, or does it have some returns to management built in? Those estimates would have some returns to management built into them. Obviously, the value that people assign to those varies by the particular operation. and so those can vary considerably, but they would have a small return to management factored into them, and hopefully the folks on the other end that are penciling these out on their own would manage those into their cow cost side as well. We don't like to work for free in this industry. So another question. Just one moment here. Give us a chance to read these as they're coming in. One of them is focused on the energy prices that we're seeing today, the decline in oil and gas prices. Will that be strengthening to domestic demand? That's an excellent question. Obviously, one of the big factors as we think about demand is obviously how much income's available to the consumer. And I think you got two factors that are going to be very favorable to demand in that standpoint. One is that you look at our unemployment number and even factor in those folks that are underemployed but still collecting a paycheck. That number as a percentage of our total working group in the United States, working population, was at 11.2% in December. That's the lowest since September '08. And so that's obviously bullish personal disposable income. And then when you look at the energy side, the government's basically estimating that the break in gasoline and energy prices that we're seeing right now will equate to about an extra $550 in the consumer's pocket over the course of 2015. That's going to increase the beef spending power of the U.S. consumer and will have a bullish factor on domestic demand. And so as we look at that, we do feel that does bode well for beef producers and being able to continue to command a record high price for beef at the retail level. We're just looking at a few more of the questions that have come in here, guys. Just one second.
There was a question relative to one of the producers usually purchases the LRP insurance on their calves every year, and they're just inquiring with the recent change in terms of more of a contra-seasonal market, when would you suggest buying that insurance? And I would say, as you look at that, it depends on when you're marketing those calves. If those are October, November marketings, then obviously I think you can be more patient in terms of the purchasing of that, because at this point, with the fall futures declining the way they have, the premiums are going to be a little higher on that insurance. If it happens to be calves, it can be more maybe a market in this May, June time frame, or very early July, like a fall calving operation, then I think you're in a situation where you'd likely have to be a little bit more aggressive here over the course of the next couple of weeks in terms of that purchasing of that insurance, if you will. You know, one of the questions was asking relative to the, and I think we'll make this our last question. We're right on the 60-minute mark, and we really appreciate your time, but asking relative to the aging ranching operation and the demographics of how that might influence the industry and expansion, if you will. And I would just say that I think as we look at this industry, the fact of the matter is that we're an industry that's going to continue to consolidate. And with that in mind, some of the bigger operations that actually have that younger generation coming back into the business will be the ones that are going to look to go ahead and take on those other operations where that older rancher may be looking to retire. That doesn't necessarily mean that they're going to take on the land base, but certainly in terms of the cow base, I think that they will. So I think we'll be able to actually move through that and not have that be a huge issue for us as we look at things here going forward from an expansion perspective. For the questions that did not get answered, feel free to send Lance and I an email with those questions, and we'll get those answered back to you. We'll get that turned back to you here within the next day. So with that, we really appreciate your time here today. As you know, this is a series of webinars that we've been doing now since the September period of 2013. And we've got other seminars that we do as well. We've got one coming up in June, a risk management seminar that really would fit for those stocker and cattle feeders. And so if you have any interest, please reach out for us on that information. And then our next Trends Plus webinar is actually going to be on June 10th at 5:30 Mountain Standard Time. So be looking for that relative to the advertisements in the updates or emails and whatnot. So again, we want to thank Elanco for their sponsorship. We want to thank all of you for your time spent with us today. And if you have any follow-up questions, please reach out to Lance or I, and we'll get back to you as soon as we can. Everybody have a great evening.